suppliers. You may return to your goods to your suppliers. Okay, so you may return to your goods to suppliers. Yeah. So by various reasons, we are going to return our goods to our suppliers, right? So for return, so this facilities is on only credit only, right? So there is no return on cash basis, only credit basis are there, because we are regularly purchasing from them. So that by that reason only we are going to return them, right? So for return purpose, so we'll open a separate book. We'll open a separate book for recording of goods purchase, for goods returned to the our suppliers. So to whom you are return the goods, to whom you are return the goods, and how much quantity you are going to return to your suppliers. So mentioned clearly in this book. So when you are purchase the goods on the base of credit, so we are recording in the purchase book. When you are return to your suppliers, so you are recording in a purchase return book. Okay, so purchase return book, right? So when purchase return book, right? See, when you are purchase the goods from your suppliers, the general entries, common general entries, purchases account debit to, right? So purchases account debit to suppliers account. May who supplied the goods on the basis of credit, so the person may credit, right? So the person may credit. And for example, we purchase the goods from our supplier 10,000 worth of the, so worth goods you are purchased, and a purchases account debit to suppliers account. So that is a general entry. And next, while returning the goods to, now in the first case, he was the creditor. Because purchases account debit to creditors account, purchases account debit to suppliers account. Now we are going to return to our suppliers, right? So for example, you are return to your supplier to 2,000 worth of goods you are going to return to your suppliers. Now you want decreased. While purchasing, the amount was there 10,000. Now you want return to your goods to your suppliers. Now you want return. Now you are return the goods to your supplier 2,000 worth. Now the supplier worth may decrease or increase? Decrease, 100% decreased. So 100% decrease. How much decrease? 2,000. In the first case, he was credited. Now second case, he will be debit, because you are returned to him, because he's a receiver from you. Okay, you are receiver from you, so that he will be debit. So when goods returned, okay, when goods returned, when you are purchase the goods from your suppliers, he will send one notice, may invoiced. So I'm sending this much of goods, and this for this, so this is a price, these are the quantity are there, and he will give every information while sending the goods to you, right? While sending goods to you, he will give the every information, right? So every information he will mention in the invoice, and he will send to the on copy to you, right? At the same time, when you want to return the goods, the purchase goods you want return to your suppliers, you may prepare one note. The note is called as a debit note. Okay, what note we are going to prepare? Debit note. The debit note means you are going to debit to your supplier. The first case, he was creditor. Now second case is a debitor. So for that reason, you are going to prepare a note. That note is called as a debit note, because your supplier will be debit. Your supplier amount will reduced. So along with purchase return book, purchase returns, you must send one debit note to your suppliers. One original copy you have to send to your suppliers, and a duplicate copy you have to maintain your office file. Okay, so purchase return in this book, you are going to record only purchases return. Okay, which you are going to return to your suppliers. So record in purchase return book. These are the purchase book and a purchase return book. Then go to the next one more. The credit is, so credit may purchase purpose, may credit may sales purpose. Now purchase related are all over. Purchase related over. What are that? Purchase when you are purchase the goods on the base of credit, so we recording in the purchase book. When you are returned the goods to your supplier, you are going to record so in purchase return book. So when you are return the goods to your suppliers, so we are preparing a note. The note we are called as a debit note. The debit note original copy will send to the our suppliers. Sir, so we are debited to you because this is the reason I'm sending back to you. Please accept. So for that you are debited. For that you are debited. So that I prepared a note. That note called as a debit note. Right. So these are the two books about purchases. Yeah, next sales book. So sales book, in this book we are going to record goods sold on the base of credit. Goods sold on the base of credit. So which goods you sold on the base of credit, so that will record in this book. Okay, so that we recording in this book, right? Like a purchase book. In purchase, so which purchased on the base of credit, so that we are recording in the purchase book. And then next sales book. The sales book here same also sales book. The sales book we recording goods sold on the base of credit. Goods sold on the base of credit will record in a sales book. Okay, will record sales book. Goods sold on the base of credit. Goods sold on the base of credit will record in a so sales book. So we are not recording if goods sold on the base of cash, or if asset purchased on the base of credit or cash. So we are not recording in a sales book, but here we are recording only goods sold on the base of credit. Okay, goods sold on the base of credit only we are going to record in this book. Goods sold on the base of credit only we are going to in this book, right? So only is a purely goods related transactions. Okay, so that is goods related transaction in that sales book. In that sales book only we are recording goods sold on the base of credit. Okay, goods sold on the based on credit. Next and next book is sales returns book. Sales return book. So sales return book like purchase book. So the purchase book also known as when you are returned to your supplier, this is called as return outwards. The return outwards. Return outwards. So now here sales return, already we sold to somebody, already we sold to our customer on the base of credit, on the base of credit. So we sold them. We need to collect cash from them. Okay, we need to collect cash from them. So because we sold, there is agreement is there, there is understanding between you and your customer is there. So that's why, that is the reason you sold goods to them. You sold goods to them. Okay, clear that. you sold goods to them. So on the basis of credit, right? So as customer, as businessman, however, return goods to your supplier, the same manner, your customer may return goods to you, because you are purchased, you are sold goods on the basis of credit. In any time, they may customer may return goods to you, or return to you. The returns we call as return inwards. So return inwards. The purchase returns we call as return outwards. The purchase returns we call as return outwards. The sales return we call as return inwards. Yeah. The when you are prepare the debit note, the same manner when the goods returned, by your customer, so you have to mention when you are sold goods to your customer. So in this case, E was debit. E was debit. So that is customer account debit to sales account. Customer account debit to sales account. So now he was debited. Now by returned, the goods are decreased. The goods were decreased. The debtor worth also decreased. By debtor worth also decreased. So that reason, so you need to prepare one more note, that note called as a credit note, because we want reduced our customer worth. We want reduced our customer value. So that so you will prepare one note. That note is called as a credit note. Credit note, because in this first case it was a debit. Now we want reduce, we want decrease him, so that sales returns. Okay, the debtor will credit. So sales returns account debit to customer's account. Here the customers we also known as a debtor. The supplier also is known as a creditors. Okay, so these four books are purely related to the goods and stock only. Goods and stock only. So stock related or goods related. Okay, so next, and in this, the four books we are going to record only goods related, which is purchased on the basis of credit, which is sold on the basis of credit only, right? So we'll open a small not account, like a statement. Vertically we will prepare so one statement, that is date, particulars, invoice, price, amount. So to whom you sold, if you are prepare a purchase book, to whom, from where you are purchased, from whom you are purchased, and at the same time next, while preparing sales book, so same, but on the heading is in particular column customer name, right? Customer name. So to whom you are sold, the goods on the base of credit. So record in this, right? So record in this. Next, and next, cash transaction. Cash transaction. The cash transaction here, we are recording purely cash related. So only cash transaction we are going to record in this. So only, no credit transaction may. Okay, which goods purchased on the basis of credit, or goods sold on the basis of credit. So the cash book is never taken. The cash book will take goods purchased on the basis of cash, and a goods sold on the basis of cash. Goods sold on the basis of cash. Okay, so goods sold on the basis of cash. So here we are recording purely cash related transaction. So cash transaction only we are going to record in this, right? May the cash transactions may current year, future year, may past year, last year, present year, future year also may will record in this book. But here the cash should be realized. So our ultimately aim, goal is, so the cash should be realized. Only cash transaction we are going to record in this book, clearly that. Okay, may present year, may future year, may past year, whatever year we don't want, but it should be receipt. it should be realized, it should be paid, it should be paid. So no receivable, no payable, it should be paid, it should be receivable only we are going to record in this book. So that's why may purchase goods, maybe you purchased asset, may you sell the goods, may sold you asset on the basis of credit, whatever basis, whatever you done, that should be in that, that should be cash only. The cash should be realized, the cash should be receipt or paid. Okay, so we are not recording may outstanding, may prepaid, means that is a receivable or payable. It should be realized the cash. And the cash book is may based on the capacity of the business. The cash book may divide into some types. So the some types are there. So here we are recording cash transaction only, and this book this book also may primary and secondary book, may general and ledger, but the four books are only journals, not subsidiary. But the cash book is both, as well as both subsidiary as well as, sorry, general as well as subsidiary book. So both right? So both general and primary and secondary book. But the four books, but the stock books are only primary books, not secondary books. Okay, right. So in cash book again divided based on the size of the business, capacity of the business, need of the business, right? So that is, so based on the that we again will divide some types, that is single column and cash book, first type. Second type, double column and cash book. Third is three column and cash book. So three type of cash books are there. So three column and cash book, right? Double column and cash book, single column and cash book. Based on the size and a need of the business, so the cash book may divide. Okay, the cash book may divide. Just now we discussed this is a primary and secondary book, and this book we prepare as per the nominal account, sorry, real account, real account, what comes in debit and what goes out credit. So we have a classification of accounts, that is three classification of there. So that is personal account, impersonal account. The impersonal account may divide into may divide into two, that is a real account and a nominal account. Okay, the orally the account classification of accounts are three, that is personal, real and nominal. Okay, as per personal account only we are recording the credit transaction, we recording credit and loans transaction. Okay, the real accounts is a purely is a related so is a related cash, it deals with cash only. So what comes in debit and what goes out credit, it deals with assets. Okay, what comes in debit and what goes out credit. And the nominal account so expenses, losses, income and gains we are recording in this book. Okay, right. So this is the situation. So based on the, so this three classification we are going to record all the accounts in the books. Okay, like that. So like that, the cash book we preparing as per the real account rule. What comes in debit and what goes out credit. That should be cash only. The cash should be realized. The cash should be realized. So cash should be realized. Okay, so cash should be realized. So what you are receipt and what purpose you are paid. Okay, what purpose you are paid, right? So that is the present, past, present, future, whatever it is. So but the cash should be realized. The cash should be realized. So this is the cash, and in this individual wise, so three type of cash books are there, that is single column and cash book, double column and cash book, and three column and cash book. So one by one we'll discuss. In a single column and cash book is also known as ordinary cash book, is a traditional cash book and a normal cash book. So the cash book, ordinary cash book we recording, and in this only current year, we recording, so receipts debit side and a payment credit side. Payment credit side we recording, all receipt debit side and all payments credit side. So this cash book information, because it's a traditional cash book, is ordinary cash book, general cash book also, right? So no additional feature in this. So what you received, right? Debit side, record debit side. For what purpose you paid a record credit side? Record credit side of the single column on a cash book. So normal small scale organization, small business will follow this small cash book. That is normal cash book or single column on a cash book. Okay, right. Next, go to the double column on a cash book. Double column on a cash book. Two column on a cash book. Here, additionally, so additionally, we are recording additional column will come in this. So what is that? That column is discount column. So before this, we'll go for a small explanation about discount. So discount. So discount may in the business, the discount is a common. The discount is a like a deduction may payment or receipt. Okay, some amount we are deducting may payment or receipt, right? So that the discount may divide into two types, may trade discount and a cash discount. Okay, may trade discount and cash discount. The trade discount we are not recording the books, only cash book we are recording in the books. Okay, the trade discount, so we are deducting or catalog price at time of purchased or at time of sales. So the trade discount will come. So that is the reason we are not recording in the books, right? So we'll recording only cash, right? The cash discount may divide into again two types. Please write down that. So the cash discount may divide into two types. That is discount allowed and a discount receipt. Discount allowed and a discount receipt. So discount allowed, to whom you are going to allow the discount, right? As a businessman, you are allowing a discount on a receipt. Yeah, which amount you are receiving from somebody. So on that they are asking you, sir, please give certain amount as a discount. So for them you are deducting some amount. Okay, some amount you are deducting at a time payment, at a time receipt. So on that receipt, you are allowing some amount to your customers. That discount is called as the discount called as the discount called as discount allowed. Discount allowed. Next, on payment, so you are paying now. On payment, somebody allowing you the discount called as a discount received. So both the discount we are recording in this. So along with receipt, we open one more column. That column is called as a discount allowed column. On payment, so again one more column open. That column we call as discount receipt column. So in this we recording, we along with cash receipt, we are opening additional column. That column is discount allowed, and along with the cash payment we are opening additional column. That column is called as discount received. Okay, discount received, right? So this both columns you are opening in at a time. Okay, so both column you are opening at a time, so that the book is called as a two column on cash book and double column on cash book. Yeah. So next, next three column on cash book. The three column on cash book, So this cash book we known as a modern cash book. Nowadays, every businessman preparing this cash book. So three column on cash book, right? A businessman want to start the business. So first we'll open a bank account in the book, a bank. So they will give one book. That book we call as a passbook. Right? This is a common. So nowadays, every businessman, they are doing the cash transaction by transaction. So with through bank only. The payments through bank, the receipt through bank. Right? So as a businessman, he want to know so what is the cash in the bank and what is the cash in the business. So he want to know so that's why at a time for reduce the time, for reduce the books, okay, for reduce the time wasting, so for reduce the books maintaining. So for this reason, the businessman will prepare a book. The book is called as a 3-column cash book, triple column cash book. Okay, single column, there is no additional columns, only one column is there, that is called a single column on cash book. And a double column on cash book along with cash. So we are opening one more column, that is discount column, a discount allowed, a discount receipt. Next, 3-column on cash book. 3-column on cash book. So we are opening 3-column on cash book. We are preparing 3-column on cash book. Along with this 2 columns, already 2 columns are there, that is cash and a discount is there. Along with this, nowadays, so we are doing our transaction through bank, so again we will open an additional column. The additional column is called as a bank column. So now total how many columns are there? One is cash, bank, and a discount, or discount, cash, bank. The book also called as a discount bank, with discount cash and bank column on cash book. Okay, and double column on cash book also called cash and discount column on cash book. Right? So this is the 3-column on cash book, and in this we are recording. So what is the payment through cash? What is the payment through checks? My bank. So what is the receipt through cash? Only cash. And what is the receipt through the checks? So everything we are going to record in this 3-column on cash book. Okay, and here see, my cash we are treating as a cash, and even check also we are treating as a cash. But both the transaction we are recording at a time in the one book only. Right? For example, cash receipt. Okay, some amount receivable from a person. He gave one check to you. He gave one check to you. Okay, one check is gave to you. Right? You received a check. You received a check for that person. Right? So, and the check you are deposited in the bank, and the next day or same day. Right? So next day. So you are depositing the bank. Right? You are depositing the bank, or leave that. So you are withdrawn cash from your business, your bank account, for your business, for your office purpose. You are withdrawn cash from your business. Okay. So what is that? So cash taking and a bank is giving, and both aspects you are recording in the one book only. Right? So both, one is receipt side, both books are there, cash book and bank book is there, bank column and cash column are there, and at the same time payment side also, bank column and cash column are there. Right? So one is payment to the bank, one is a receipt to the cash. Right? So receipt, from where you are receiving, from bank I am receiving. So to bank account in the cash column we are writing. So, and the payment side, go to the payment side, the bank is paying to whom? For cash. For cash. So by cash in bank column. Means at a time you are writing both aspects. So for example, cash account debit to bank account debit to cash account. Both aspects columns are there in the book. Both aspects columns are there in the book. Cash column is there, bank column is there, and both aspects you are recording at a time in the book. Both aspects you are recording at a time in the books. Right? So cash, so that when the situation is came, the situation is called as contra entry. What entry we call? Contra entry. So symbolically we are used while recording of this aspects. C contra. It means C means contra. Okay. So these are the cash books. So 3 columns, single column on cash book, double column on cash book, and a 3 column on cash book. And tomorrow we'll do this problems in system, right? So next and next bills payable book and a bills receivable book. So bills payable book means, so this bills payable book for goods purchased on the base of credit. For them we need to pay. So that is bills payable, and receivable to whom you sold is a receivable from that. So we need one document. So that's why we preparing receivable book and a payable book. And the last one more very important and important book is that is general proper. General proper. The general proper is except 7 books. Which books are not recording, the book will record. May see, if you are purchase asset on the basis of credit, where we have to record, the purchase book is not recording. If you are sold asset on the basis of credit, where we are recording, so where we are record, so the sales book is not taking, then where we have to record. Then where we have to record, so that, so if you are purchase asset on the basis of credit, if you are sold asset on the basis of credit, so we have to record in general proper. We have to record in general proper. Okay, general proper. So in this, in 8th book, we are going to record. At the same time, again, some payable, receivable. The payable book is, the cash book is not recording this payable and receivable transaction. Then where we have to record, then where we have to adjust. So as per, so the general proper we are going to adjust, so that, so the general proper, under general proper comes under some opening interest, closing interest, transfer interest, okay, rectification of errors, endorsement, depreciation, and a recording of asset purchased on the base of credit. Asset purchased on the base of credit, so we recording as per the general proper. As per the general proper, we recording. So these are the 8 books. Okay, these are the 8 books. For example, opening book. Okay, so last class we discussed it clearly, that is going concern concept. Going concern concept. The going concern concept says, the going concern concept says every business should run for the longer period. So in the longer period processed, the division is common. The division is common, right? And the longer process, tomorrow we are, see, last year ended, 2022 completed, right? But we are not stopped all the activities. Okay, but we are all are not died, but we are all are live. Some are, so who are died, excuse them, but we are live, we are carry forward the lives, and we are in, we know everyone, we are in fresh mode. So we are in new year. So the new year is going on. At the same time, the business also humanity, that is artificial humanity, entities, special entities there. So that is, it will carry forward the business assets and liabilities. Okay, and expenses, income, expenses, so that it will forward to all the assets and liability to the next year. So for that, we are carry from last year to current year. So we'll record, we're writing one entry. The entry we call as opening interest, for recording, for writing of the asset for carry from 1 year to another year. So we writing the one entry, that is entry called as opening interest. And a closing interest at end of the year. So we want to know the profit or loss of the business, so that what happened in the year, so you must close it certain area, certain place. So for knowing profit or loss, okay, for knowing profit or loss, so you close the current year data transactions. Adjustment interest at the end of the year, all are not clear. So some are payable, some are receivable, some are depreciated. So that for that you may write one adjustment, right? So next, bills of exchange, that is you have a in second semester. Right? So these are the general proper, and these are the 8 books of subsidiary books. 8 subsidiary books. 8 subsidiary books. So once again, I'm telling that is total subsidiary books are 8 types are there. One is purchase book. In this, we recording goods purchased on the basis of credit, then purchase return book. So which goods you are returned to your suppliers, so that we are recording in this. And along this, we'll prepare one note. That note is called as debit note. Okay. And record only goods sold on the basis of credit and a sales return book. So in for sales return book, we will prepare one note. The note is called as credit note. And the next cash book, the cash book may divide into 3 types: single column and double column and triple column and cash book. And in triple column and cash book, one problem, one situation will raise. That situation is called as contra situation. Then bills receivable, payable, and general proper. Okay. And tomorrow I will do the problematic on this, on all 8 books. Right? Right. So tomorrow we'll meet. Thank you, everyone.
Thank you, sir.
Thank you,
Okay,
sir.
ma. Thank you. Please attend tomorrow, because tomorrow completely problematic session. So please attend everyone tomorrow.
Okay, sir.
Actually, today a little bit later. Thank you, everyone.